What are psychological levels? Psychological levels refer to price points in the forex market that are significant to traders due to their psychological impact. These levels often align with round numbers, such as 1,000, 15,000, or 100,000, which traders tend to remember and react to. These numbers can act as support or resistance levels, influencing market movements and trader behavior. The importance of psychological levels lies in market sentiment, trade decisions, and risk management. Psychological levels often reflect collective trader sentiment. When a currency pair approaches a significant level, traders may either buy or sell based on their expectations, creating a self-fulfilling prophecy. Many traders set their stop loss and take profit orders around these levels, leading to increased trading activity and volatility. Understanding these levels can help traders manage risk more effectively. Knowing where traders are likely to place orders allows for better positioning of trades. Common psychological levels in forex trading include round numbers, previous highs and lows, and Fibonacci retracement levels. Round numbers are perhaps the most recognized psychological levels. Traders often perceive these levels as critical points where the market might reverse or consolidate. For example, if the EUR-USD pair approaches 1,200, many traders may place buy or sell orders around this level, anticipating a bounce or a breakout. Previous highs and lows also serve as psychological levels. Traders often look back at historical price points to gauge potential future movements. For instance, if a currency pair has previously peaked at a certain level, traders may be cautious about entering long positions as the price approaches that level again. Fibonacci retracement levels are widely used in forex trading and can coincide with psychological levels. Traders often use these levels to identify potential reversal points, making them essential in a trader's toolkit. The psychological impact of trading is significant, with fear and greed being two of the most powerful emotions. These emotions can lead traders to make irrational decisions, such as holding on to losing trades for too long or jumping into trades without proper analysis. Understanding psychological levels can help mitigate these emotions by providing clear entry and exit points. Additionally, the allure of hitting a psychological level can lead to overtrading. Traders may feel compelled to enter positions based on the belief that the market will react significantly, even when the setup isn't ideal. This can result in unnecessary losses and increased transaction costs,